here's exactly when to buy VOO, SCHG, and QQQM in a stock market crash. It's no big news that the stock market has been crashing and pulling back as of recently. ETFs like SCHG is down over 8% in the last month, VOO is down almost 5%, and QQQM is down over 7%. Now, I do own all three of these ETFs in a very large capacity of easily well over $100,000. Now, investors like yourself might be wondering when to buy ETFs or what's the best way to buy ETFs in a recession or a stock market crash. Now, the obvious answer is to dollar cost average or DCA. Now, in this video, I'm going to teach you exactly how to buy ETFs so you can get the lowest price possible and make your money go way further than if you were to blindly dollar cost average. I personally use this investing strategy every single time the stock market is down, and literally I've been buying thousands of dollars worth of these three ETFs and so much more in my entire ETF investing portfolio. So let's get started with the basics on what dollar cost averaging or DCA means, because it's one of the best tools in your arsenal to buy ETFs on a regular basis, especially in a stock market crash. Dollar cost averaging or DCA is one of the most popular and proven to be successful investing strategies, where you invest a fixed amount of money at regular intervals. You do this regardless of the market or ETF price, aiming to lower your average purchase price by buying more shares when prices are low and fewer when they are high. Essentially, dollar cost averaging mitigates your risk of trying to time the market by spreading out your investments over time, because we all know, and hopefully you know, that time in the market always beats timing the market. Now, dollar cost averaging in this process is exactly what I do on a weekly basis when I go in and buy my ETFs. Here's a very simple and easy way to see how to actually buy ETFs using dollar cost averaging. As you can see, you're just continuously buying regardless of if the market goes up or if it goes down. This is a great example of how to buy ETFs as a long-term investor, and here's an even better example of exactly how to DCA into ETFs during a stock market crash. Now, for the average investor, the best thing that you can do if you don't have that much cash on hand or in buying power is to just automate your investing process. So let's say you get paid every single week on a Friday on a weekly basis. So the best thing that you can do is to just DCA on that Friday. Now, if you get paid every other week or on a bi-weekly basis, just invest every other week or bi-weekly and just buy your ETFs. And if you get paid every single month on a monthly basis, just buy one time that month and then set it and forget it, because this way of DCAing is going to be less stressful on yourself and more efficient in the long run. For me and my 401k, my company pays me on a bi-weekly basis or every other week on a Friday, and I don't touch this account. Now, so far it's at around $17,000, and every 2 weeks my company on a Friday will go in and DCA into my ETF of VTI and do it for me automatically without me doing a single thing. Why people dollar cost average or a DCA is because no one can predict the future of the stock market. No one knows if we're going to go up, if it's going to go down, if it's going to be a recession, a bull market, a bear market. Nobody knows, not even Warren Buffett. But one thing that people do know is historically and hopefully in the future decades from now, that the stock market always goes up in the long term, and hopefully you are a long-term investor. So as you DCA along the way, sure, you might be down in the short term, or you might be even lucky and in the green in the short term, but over a long time period and over many decades, companies will expand and grow and innovate, economies will grow and expand, and as that happens, so does the stock market. Prices will go up over time. You will definitely be in the green at some point and have some good profit and compound your returns. Basically, what I'm trying to say here is the longer you invest, the lower risk you have of actually losing money, and as time goes on, the greater chance you have of actually making money and having some positive returns. For example, to further prove my point, if we take an ETF like VOO or the S&P 500 index, if we invest for just a 1-year time period, there's a 74% chance we make money and a 26% chance of us actually losing money. If we invested in VOO for 5 years, we now have an 86% chance of making money and just a 14% chance of losing money. Now, if we invested for a decade or 10 years, we have a 94% chance of making money and just a 6% chance of losing money. And finally, if we invested in VOO or even other high quality diversified ETFs for 15 years, we have a 100% chance of making money. Clearly, the longer that you invest, the higher likelihood and chance of you actually making money. So don't sell out because the stock market is down or fears of a crash. Just keep on investing and stay the course. Okay, so now that we know how to DCA and that we are long-term investing, in this part of the video, I'm going to show you guys exactly how and when to buy the dip to get the lowest possible price and even make some money along the way in a recession or a stock market crash especially. Step 1 is to have some buying power or some cash on hand in your investing account. As for myself, I currently have over $22,000 in buying power or cash on hand in my taxable brokerage account and over $4,000 in buying power in my Roth IRA account. Now, I didn't rob a bank or steal this money. I feel like that's a lot of money, like $25,000 at least plus in my account in cash and buying power. And I'm 24 years old, so how I got this money was I got a bonus last year in December of 2024 for my performance in my company from last year, and I've been saving a lot of this money on the side to invest during times like this in a stock market crash and a stock market recession that we might have, because I knew that in 2025 the stock market is going to be more volatile than usual. A lot of different things are happening, and I have this cash on hand to buy the dip. You might be wondering, why do I need all this cash on hand or some cash or some buying power if I'm going to be a long-term investor in a stock market crash though, or a recession? The dip could keep on dipping, and it keeps on dipping and dips some more and dips even more and even more and more and more. So you want to have some cash on hand to buy ETFs at a lower price and to decrease your cost basis to have the best possible chance of making a ton of more money in the long run when the stock market eventually reverses and goes up into a bull market to all-time highs. Trust me, you'll make way more money in the long run than the person who bought the stock market at the highest price possible and then just gave up and raised the white flag than the other person who bought the stock market at lower and lower prices along the way because they had a cash on hand than the other person who just bought it once and then gave up. Another benefit of having buying power or cash on hand is that money actually doesn't lose money at all, because most brokerage apps have their buying power or cash on hand in short-term treasuries or into some money market funds or some sort of bond, which is a low-risk asset and actually earns you money and actually earns you interest every single month. For example, my buying power is sitting in VMFXX, a federal money market fund on Vanguard. Over 4% is the yield on this cash or interest on this cash, where it's a low risk asset of a 1 on Vanguard's risk scale. And this fund pays me on a monthly basis, where it accrues this cash on a daily basis. However, the distribution yield changes from month to month depending on the current interest rate environment. In January of 2025, I got an interest payment from having my cash as buying power in this account, earning interest of $87.29 in my brokerage account and $3.18 in my Roth IRA. Then in February of 2025, I got another interest payment on the second month or a monthly basis of $78.86 in my brokerage account and $14.89 in my Roth IRA account. With all that out of the way, now that you have your DCA strategy down, your cash on hand or buying power ready, now it's time to buy your ETFs like a pro. A quick disclaimer is that I've noticed this strategy I'm about to show you only works with broad market ETFs, so think your S&P 500 funds, your total market US-based ETFs. It also works with growth ETFs or technology-focused ETFs, so the ETFs like that will work perfectly for this strategy. Now, it doesn't work, unfortunately, as well with the dividend ETFs or value dividend ETFs as much. Drum roll, please. Now, the best time to buy ETFs in a stock market crash or a recession is to buy them at the end of the day. Yes, I said the end of the day, specifically the last hour of the trading day in the stock market for your ETFs. Now, this might be kind of confusing, but stay with me. So as you can see, there's so many times when the stock market is open in the morning to close, and then it opens up at a high price and then falls to a low price right before the last hour of the trading day. Now, this all happens when the stock market closes on a red day, when the stock market goes from green to red or red to even more red, and at the end of the day is the lowest price right before the stock market closes to get the best price possible. So literally when the stock market is at the end of the day, I go in and buy my ETFs in a red day to get the lowest price possible. I do this every single time. It's almost automatic that I go in and buy ETFs in the last hour of the trading day. Usually it's a gradual trend to the lowest price by the end of the day, because the stock market kind of sells off over time in a red day. And if you have the patience, you'll get the best possible price for that day by the end of the day. I honestly love this strategy so much because it's way less stressful. You're not going to be checking your phone constantly or just staring at the screen all day like those weird traders that you see online. You're just going to be chilling, sleeping, and just relaxing and waiting until the last hour of the day of the stock market trading day to buy your ETFs. You might be wondering, well, why does the stock market tend to go down at the end of the day? Holding overnight is way too risky for most day traders. Basically, a day trader will sell their positions, and when they do sell their positions, it tends to push stock prices down before the close. So when day traders sell their positions by the end of the day, you as a long-term investor will go in and place your trade or your buy for your long-term ETF portfolio. And a fun fact is that institutions like to buy huge lots of buys at the end of the day as well. Another reason why stocks tend to go down by the end of the day is this phenomenon called power hour. The stock market power hour occurs from 3 to 4 p.m. Eastern time. And this has to do with traders making a lot of trades before the end of the regular session. So the huge volume creates excessive volatility in the stock price and in ETFs, thus creating some amazing opportunities to make profit in the long run. Now that's exactly why I told you guys to buy ETFs at the last hour of the stock market open or the trading day, because you're gonna have some power hour movement of stock prices going very excessive volatility, so you could get the best price and you have an amazing opportunity by the end of the day when stock prices go down to profit in the long run. So to sum this whole video up, here's the best way to buy ETFs in a stock market crash or a recession. Step 1, DCA or dollar cost average. Step 2, have buying power or cash on this side. Step 3, buy at the end of the day in the last hour of the stock market. Step 4, gradually deploy your buying power in case of further dip opportunities. And lastly, step 5, be a long-term investor and be patient and just stay the course. Now, if you want to see exactly when I buy the dip on all of my ETFs in my investing portfolio, check out Blossom and check out the link in the description of this video for this free investing app. On Blossom, you get to see that I buy my ETFs at the end of the day, and you'll see all the time any trade alerts on my ETFs when I buy them only on Blossom. So with that, I'll see you there on Blossom. If you guys like this video, please give it a like because this cute puppy did. Right here's going to be a video when I literally ranked 55 of the best ETFs to buy and hold forever. So check out that video if your ETF is in the best tier ranking, or if it's in the worst tier or just not the best tier ranking. Love you guys so much. Continue to crush in the stock market and take it easy. Peace.